Good morning, everybody, and welcome to the maiden voyage, the inaugural show, See the Futures, 10:30 Wednesday every week. And we have special guest hosts, which I'll introduce in a second. It's going to be a lot of fun, product-based show. Type in your questions and answers as we go. We have some serious, experienced pros with us today. My name is Jim Cagnina with Ninja Trader. Before we go any further, I do want to remind everybody, trading futures, options on futures involve substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, although that's an equation for opportunity, which I think is why we're all here. It's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I could afford to lose doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. Stress is a big deal in life. We make bad decisions when we're under stress. Easy on the day trade margins. You get plenty of leverage with futures as it is. We may or may not be throwing some trade ideas in on a real-time Ninja Trader simulated live trading platform today. None of this should be construed as trade or investment advice. All right, so I have to introduce you right away. Bob Iaccino. Bobby Iaccino is with us. He is going to be a frequent presenter here with us, and him and his partner, Jimmy Iorio. And I'm pronouncing that the way I'm told to pronounce it, being a fellow Italian. I think I'm close enough. But let me just say, hey, Bob, how are you?
Good, Jimmy, and you are close enough. He'll be fine with that.
All right, so just to give you a little background for this first time, you'll see Bobby's videos on the CME group. Educational oriented. He is it's kind of like me. He's been around a long time. He has experience on the floor of the CME and the old Chicago Board of Trade floor, which was a place of wonder and merriment. Co-founder and chief market strategist at Path Trading Partners. Long resume here, 30-year insider, ran a CPO. I'm going through the bullet points right now. I'm just so excited that you're here. On the investment committee of hedge funds for 8 years, frequent guests and analysis on TV and all over the place. We are lucky and glad to have you, Bobby. Thanks for being here.
I'm really glad to be here. As a matter of fact, we're like the deep state of futures, I think. That's the way I always refer to it. We've been around for so long and they just can't get rid of us.
I know. We'll never go away. I told my wife, there's two things. One, I'm going to keep doing this until I'm no longer moving, and then just bury me in the backyard. We'll be done. Oh my God. So in any event, just like me, so you're similar to me, right? You've been in Chicago a long time and then you took the move to the South?
Yeah, I left about 18 months ago to go to Naples, Florida. We actually spent a month in Naples in June of 2020. And when I left, I used to hear about one gunshot a month and they were far away. And when I got back after the month of June, I heard one gunshot a week and they were close. So I said, I think that's enough for me. I mean, I know Chicago inside and out. It's always easy to move back. I spent time in New York, Los Angeles, Chicago. Chicago's always going to be home. But I'm enjoying the warm weather and enjoying not hearing gunshots.
I hear you. My thing was shoveling snow. I'm done with that.
Yeah, I don't have to do that anymore either. I do have to kill the occasional cane toad. Hope that doesn't upset anybody.
Not me. All right. So, timing of this title of this show is perfect. Timing is perfect. You know, what do we think about correlations between the four major benchmark indexes, ES, NASDAQ, Dow, Russell, especially in light of CPI today?
So I have to tell you, my company is Path Trading Partners. We do boutique analytic for small institutions, right? So our analytics, it may actually go out to some of the people watching this. We don't know because it's white labeled out. And we've done some work on these correlations. And there's actually been a lot of work done. Like, you don't have to take my word for it. You guys can just look at this stuff. And everybody thinks the indices are correlated at basically 1. So if you know anything about the correlation coefficient, it's basically from 1 to 0, and the correlation can be negative or positive. So everybody will assume the correlation is positive, which means it goes the same way. An example of a negative correlation would be precious metals and the US dollar. They tend to go in opposite directions, or inverse correlation, as many people call it. Obviously, the indices have a positive correlation, and you would think that they would be 1 to 1. In other words, NASDAQ goes up, Russell goes up, S&P goes up, Dow goes up. But that is actually not the case. Some people might be surprised to think, for example, the correlation between the Russell and the NASDAQ is 0.9, meaning they only go in the same direction about 90% of the time. Still very high, but not one. When you look at the S&P, it's a little close to one, it's 0.96. And this is over about the last 20 years or so. People also don't know that over time, small caps outperform large caps. A lot of the things that are market related, Jimmy, are obvious if you think about it. I mean, what's going to outperform? A small cap company that's disrupting, that has a new revolutionary product. They just don't have enough market capitalization or profit or honestly stocks out there to be considered large cap. Who has more room for growth, them or Apple or Microsoft or Google? In terms of room for growth on a percentage basis, small caps do. So over time, small caps outperform large caps on a percentage basis. Because of that, when you see the Russell getting weak, you should pay attention. And that's something that we've seen over a long period of time now. If you go back and look, NASDAQ and S&P were making new highs, the Russell was not. So when you go to that 0.9 correlation, the way a lot of people use correlations is they say, okay, if something that's highly correlated, which we'll say 0.9 is, I'm looking at the NASDAQ to the Russell right now, then you would say, okay, well, they have to converge. They have to come back to acting the same way. So that's when you start paying attention to something. When you see that the NASDAQ, for example, is making a new all-time high, or the S&P is making a new all-time high, and the Russell is not, something has to break. Now, in this particular case, in the recent moves we saw, it was actually the Russell that caught up to the NASDAQ and the S&P, but then it weakened. The Russell went into bear market territory before anything else did. If you do technical analysis, oftentimes there's a back and fill or a move to a level. Jimmy, you know this, a move to a level, and then it fails from that level. That's what I called the Russell catch up earlier in the year. When the Russell caught up and made a new all-time high and then failed from there, I right away went into there's going to be a bear market sort of mode, and maybe not a bear market, maybe a correction. And I talked about this in one of my TV interviews in December. I said, I think there's going to be a really deep correction and possibly a bear market sometime in the third quarter of 2022. Now, obviously, I was wrong on the timing, way wrong on the timing. But as you look at it right now, we've got a NASDAQ that has gone into bear market territory. It's down 20% from the all-time high as of a couple of days ago. The Russell down about 24. Let's go as of Friday. The NASDAQ was down about 21%. The Russell was down about 24% from their all-time highs. And when you see that happening, you now got two of them, right? So what's in the middle of that? The S&P with a 96 correlation, a 0.96. So if you see the two that are further correlated, 0.9 versus 0.96, what is likely to happen? Is it more likely that the S&P pulls the other two up, or that those two pull the S&P down? I would argue that somewhere above 50%, it's more likely that the S&P and the Russell and the NASDAQ pull the S&P and the Dow down with them.
That's very interesting. You know, it's these correlations we have daily charts that we're looking at right now on the screen, and you're kind of looking at, early January highs to where we're at right now. And you're mentioning 20% as kind of the level of technical definition of bear market.
Sure. Yeah, bear market's one of those things, and you know this, Jim, from being around. These things have definitions. I don't want people to be afraid of the definition of something. The definition of a bear market is down 20% from an all-time high. The only way you get out of a bear market is with a new all-time high. Otherwise, you are in a bear market. Okay, and that's not necessarily a negative. There are bear market rallies that money can be made from, and quite a bit of money can be made from. But you have to understand that as long as you're in a bear market, there's more risk to the downside. It just works that way. I'll give you an example. In the tech wreck in the early 2000s, the NASDAQ fell 78% from high to low, okay, from peak to trough. In that, there were 5 rallies over 10%. Within that, there were 3 rallies over 30%, and 2 of them were over 40%. So money can be made on the long side in bear markets. You don't have to think that, well, it's a bear market, I got to be short, or I've got to get out of my cash positions, your 401k. You don't have to think that way. But you do have to realize the bear market has a definition. It presents a different set of opportunities.
Okay, so let me just ask you this. This is so from an intraday point of view, and a lot of times we explore this idea in our morning sessions. We might be trying to get long, S&P, we might try to be getting short NASDAQ. So that kind of makes sense from an intraday point of view as well, right?
Absolutely. I mean, I'm sure you look at on some way, shape, or form, either the weekly trend or the daily trend when you're looking at stuff intraday. Okay, is it weak today? Is it strong today? Within a major bear market or within what I would call a daily chart bear market, okay, it could be a weekly as well. When you're going high to low, you're just looking at the ultimate high to the ultimate low. When you're looking at it from that perspective, you're looking at an overall trend that's down. But now as you start to go down in time frame, which all your technical analysis should go from big time frames to small, right? So I may think, okay, I'm in a bear market. I want to look for long to medium term shorts. Okay, but within that, I may be able to dial into a short-term long, or I may be able to look at a short-term long signal as an opportunity to get a better price on my short. So this is absolutely the case. The time frame really makes a difference, but it doesn't change the fact that in the Russell and the S&P, we're in a bear market. And as of the close 2 days ago in the S&P, down 17.07% from peak to trough. So we're almost there with the S&P, and it's why I think there's probably more downside, but I am, believe it or not, looking for a medium-term bottom here, something in the range of 18 to 20% higher before we resume a down move.
Interesting. I'm going to steal one of your quotes that you threw out at me the other day. I'm just looking at the upper left chart here in the E-mini S&P. This is a daily chart. Clearly, just glancing at it, it looks like it's, bias has been negative, right? It looks like its bias is down. Today, we're trading 40.34. And this is the quote I'm going to steal. This is a face rip and rally in a down market.
Yeah. And I think it's actually going to continue. If you look, those moving averages you have that I asked you to put on the charts, and I appreciate that they're on there. That's something we at Path Trading Partners call the rotation zone. Okay. So we don't trade moving average crosses. If any of you have ever tried to or have researched that, it's, if you're having success at it, please reach out to me personally because I want to know what you're doing. Moving average crosses really can rip you up when we go sideways. But what we do use these for is as an idea to get a good level on an occurring trend. So in other words, if you take that ES, that top left chart, okay, the moving averages crossed on about April 18th, okay? They crossed down. Are you supposed to short that? No. But what we do is we short moves up into that zone. Okay, so if you're looking at it, again, that's the rotation zone. So an exact price level. So what we look for is a move into the rotation zone, which happened basically, you started to get the move up on May 2nd. Okay, and then it goes up into the zone and then fails. So just to give you an example of how we might set up a trade, there's quite a bit more to this. So I don't want you guys to run out and trade this. That would be irresponsible of me. But what I would do is I would draw a trend line and what I would call a best fit trend line. So in other words, it doesn't have to be perfect. And I would draw a trend line along the closing prices or the lows of the candle bodies, not the lows, from about April 29th to about May 3rd, an upward sloping trend line. Okay. If you're able to draw that, and again, just a best fit line, right? It should be
April. I'm sorry, Bobby. April 23rd to when?
April 29th.
Oh, 29th. Okay.
Yeah. So that big red candle there to your right, that one.
Yeah.
Just kind of draw a slight upward sloping trend line. And we call it a best fit trend line. When I get a move up into the rotation zone and the overall mood of the market is bearish, and I get a close below that trend line, we may or may not initiate a short. And I say may or may not because there's other factors. A lot of it has to do with the target and the reward to risk. But that would be a good indication of a short in a bear market. That might be the kind of thing we would look for. Now, when you're talking about this rip your face off rally, well, what am I expecting the market to do? By the way, this trade did reach its target. So what am I looking for now? Well, probably a move back up into the rotation zone. Okay. So if you just look, the shortest move is going to be somewhere around a move up to about 41.14 or so, right? Where you see that first moving average, all the way up to somewhere around 42.07. That's a big move, especially for an intraday trader. So if I were looking to potentially take advantage of a long here, I would go down in time frame. I wouldn't be doing it off this chart.
Got it. Makes total sense. And that kind of answers my question. Because, again, on an intraday basis, you see momentum, strong momentum, not only from an indicator point of view, but from a volume profile point of view, which is like, wow, all right, I'm not looking for places to sell right now. This is counterintuitive.
Right. A lot of people will, as you see these sell-offs, and you see the same thing on rallies, but more so on sell-offs. Remember, equities have a natural upward bias. It's slight, but it's there. And that's because there is a lot of money that goes in every month into long-only mutual funds. So it's the only thing that we trade as futures traders that has this natural upward bias. Pretty much everything else, other than seasonality, can go in either direction at any time based on supply and demand, right? We're not talking about that today, but we saw that with soybean meal with the collapse. But from a perspective of the upward bias that equities have, I certainly don't want to participate from the short side in a short covering rally, which happens when the momentum to the downside stalls, right? And it feels to me like that's what we're seeing here. We got the CPI figures. The CPI figures beat. And I would argue the market currently isn't taking them as seriously as they should. The bond market is. I mean, if you look at yields, we had 10-year yield this morning in the US at 293. I'm looking at it right now. It jumped over to 3.03%. We're at 3% now. So that's a big jump. On May 6th, we had a 10-year yield settlement at 312. So we were down 17, 19 basis points from that level. And then we rallied back up above 3%. If you look at the CPI figures, the month over month core is what bothered me and what is likely to bother analysts over the coming weeks. Because while every single reading of CPI beat expectations, they were all lower than last month, except for core month over month. So what is core month over month? What are we all feeling pain in right now, right, Jim? We're feeling pain in food. We're feeling pain in gas prices, in electricity, in heating, where you might still need it in Chicago. I haven't needed it here in 18 months. But over that time, you're feeling that pain in actual things that the Fed doesn't even want to look at, right? They like to look at the core data. So if you look at it from that perspective, go ahead, Jim.
No, I mean, the core was what, 0.6% is, expected was 0.4. The average, when I read that, I just see the numbers like, oh, it doesn't look like that big of a deal.
Right. And that's the interesting part. If you go across the whole slew of them, and I'm just going to read them off really quickly off my screen here. When you look at the headline number, the headline year over year was 8.3, and that beat expectations, but was 0.2 lower than last month. Okay. Same thing on the inflation rate month over month, the headline. It beat the expectation, but it was up 1.2 last month. It was only up 0.3 this month. So it's actually a pretty decent improvement, right? Same thing on the year over year core. And the year over year core was 6.2, was expected at 6, but last month was 6.5. So you can understand why people might think, okay, it was bigger than expected, but still less than last month. So maybe we've reached peak inflation. Now you take that core number. The core month over month inflation was up 0.6. It was expected at up 0.4, but last month was up 0.3. So it's double last month's number. And that's really without some of the other increases we saw. We saw used car prices fall last month. They're up again this month. Okay, we saw fuel prices stabilize. This, of course, is ex-fuel, but it bleeds into other things in capital markets and in industry. When the fuel prices go up, it bleeds into the increase in prices in other goods. We'll probably see that in PPI. And if you go to last month's PPI figures, they were stronger, which is not in this number. It's going to be in the next number. So I think the market isn't taking it seriously, but you do expect short covering in this kind of a move. So if we were looking to get short again, it would be up in that rotation zone.
Well, so that begs the question, and I get this a lot. You have pretty much three major crosswinds, maybe more, but three major crosswinds hitting you at the same time. We have inflation, we have a war, and we have a lockdown in China. Mm-hmm. Is FOMC just take primacy over all of this other stuff, or no?
The FOMC has to attack what they can control because there's so much that they can't. The interesting part about them is a lot of people have said this. I'm one of them. They should have tightened last May, at the latest last June. Now, it's easy to say that now. I would argue if you go back to my TV spots then, I was saying it, but whatever, it's not about me. They should have done it then as inflation was rising, but they were afraid of the effect on asset prices, right? They were afraid of another taper tantrum. Also, I hate to say this, Jerome Powell had not been renominated yet. As soon as he got renominated, he turned hawkish. He right away said we have to attack inflation. Now, if you just take it from a perspective of where inflation is, Jim, 8.3% today on the headline, the Fed wants it at 2%. So what does success look like in inflation? If they cut it in half, we're at 4.1, 4.2%. That's still double their target rate. There's also one more thing to note. We've never dropped inflation by more than 2.5 points and not had a recession. We have always had one if inflation has fallen 2.5 points or more. Now, if you think about what's behind that, what slows inflation? Well, a drop in demand, recession, they all go together. So I'm not actually putting any blame anywhere when I say that. But the Fed needs to jump in and control what they can because they can't control supply chain. They can't control energy prices. All they can control is demand in other areas. And if they raise rates, it raises credit card bills, it raises mortgage payments, it slows home building, it slows the demand for lumber, as we've seen lumber prices go up, slows the demand for copper. That's all they can control. So they're jumping out to try and control it.
Yeah, it makes sense. Yeah, we did look at a lumber chart this morning. It's finally coming back down to earth. And maybe this building boom is going to end. You know, it's when I moved to Charlotte the first time, everywhere you couldn't get a contractor to build a house. They were too busy.
Yep. There's obviously there's a lot of building going on in Naples, Florida. There's a home builder called Pulte, obviously a publicly traded company, so everybody's heard of them. They just had a home drop out of escrow because the buyers couldn't get financing at the new rates. They were approved at the old rates. Okay. So I know somebody that works there and I inquired on the home. It's a really nice home. It's a 4-bedroom home. And I'm like, you know what? Do they have anybody for it? I might look at it. They called me back and they said it's already reserved. They're only releasing 2 homes a month right now because they can't complete them. They can't complete the building of them. And that's supply chain. So these anecdotal things obviously are not hard data, but they certainly are telling in a lot of reasons when you aggregate them with other things that you're hearing and that the people watching us are hearing.
Yeah, that totally makes sense. A quick question. I don't mean to put you on the spot. We didn't talk about this ahead of time or not. Okay. Your moving averages, are they proprietary or could we share those with you?
No, you can put them out there. I'm good with it. The name rotation zone, you have to pay me 4 cents every time you say it, but otherwise it's fun.
I'm not going to say it. All right. So we basically have a 200 period simple moving average. We have a 50 period exponential moving average. We have a 21 period exponential moving average. And then we have an 8 period exponential moving average. I'll leave that up on the screen, everybody, for you to take a look at.
Now, people ask me all the time, why the 8 and the 21 and why the exponential? The exponential is because we believe, especially in shorter term trading, and just for the record, our average hold time is 26 days. Okay, so I consider us medium term, right, when we trade. But even in shorter term and medium term, recent price action matters more than past price action. It just does. And that goes back to my days in the pits. Right. You can always see a guy let's just use the example of the S&P right now, where you see this collapse in the S&P since about April. If we were to rally back up, there'd be a lot of guys that say, I'm not buying it here because I got my face ripped off last time it traded here. They have short memories on price. Even if the phrase I just said makes no sense at all. They just, I got killed here. I'm not getting involved here again. So recent price matters more than old price. That's why exponential. Why the 8 and the 21? Tested out better over 30 years of data. They just test it out really good as an area where you might want to get short or long. If it rotates back up or back down into that area, I want to stress there's also a handful of other things we look at, including my fundamental view. I also want to stress that my technical team is able to overrule my fundamental view. So I might have a fun, like I remember I wanted to buy Chipotle shortly after the salmonella scare they had, and the tech team kept saying no, and they saved me a lot of money because I would have gotten killed on those trades. So there's a lot going on, but I will tell you that this next rotation up on all of these, I believe will be a very solid short.
Very awesome. Appreciate that info. We have a couple minutes left. Now, it came to my attention, you and Jimmy have a podcast you're launching.
Yeah, we do. We launched a podcast. I think we're through about 6 episodes. It's called Futures Edge with Jim Iorio. Jim is the host. I'm the co-host. He also calls me the producer and the boss, which is technically correct. I book all the guests. I have the editing done and all that. And we've actually had some really big names reach out to us to want to be on the show. We've had Cameron Dawson, who's a frequent guest. We've had Carol Roth, who's very big on Twitter. Amelia Bordeaux from Exante Data, who's wicked smart. Ryan Dietrich. If you guys don't follow Ryan Dietrich on Twitter, you should. I call him the voice of reason because he's a financial advisor analyst, and he's always calming people down about big moves. Coming up on a show, we got John Najarian. We've got Carly Garner. So got some very big names. We interview them for about half the show. And then we give out actual futures trading examples toward the end of the show, things that we're either in or looking to get in.
That sounds awesome.
Yeah, you can find it. By the way, I should say this. Path Trading Partners has a YouTube channel. That's where we put the podcast. So if you go to the Path Trading Partners YouTube channel, it's also on Spotify under Futures Edge.
Sweet. That's awesome. I'm looking forward to listening to those as well. Any questions for Bobby? We're doing this every week, everybody. And by the way, I appreciate the thumbs up on the YouTube channel. Greatly appreciate it. Appreciate everybody being here for sure. We're doing this on a weekly basis. I think Jimmy's up next week is my understanding. Yep. Different topic altogether. And it's going to be a different topic, product-based, focused on CME more or less, maybe not. Maybe we'll look at some other futures markets as well. But this is a great start to our first launch. I really appreciate it. We do have a question here, though. I do want to throw out from Mike from YouTube. Says, Bobby, can you speak to the crypto dumpster fire going on in correlations to markets?
I can actually. So a couple of things. Number one, if you know much about crypto, then you know about stable coins. And you know that the risk the stable coins hold for Bitcoin. Well, Luna, which was one of the stable coins, absolutely, I almost cussed, just absolutely collapsed recently. That results in Bitcoin selling because they need to bolster with dollars. So that's number one. I expect more of those to fall simply because of the overall environment of sort of risk selling, but also the correlation. So if you've seen me on TV, I talked about a month and a half ago, maybe a month ago, that I exited all my crypto holdings, even the stuff I was holding long term. And that was for 3 basic reasons. Number one, I was worried about the stable coins and the effect they're going to have if and when they collapse. It is, I believe it's a when, but I could be wrong about that. Number two, because I believed that there could be some really broad regulations that could affect the crypto world. It hasn't happened. So I could be wrong about that. And so far I am wrong about that. But number 3, and probably the biggest reason, is I saw a big sell-off coming in the NASDAQ, and Bitcoin specifically in the NASDAQ are almost at a 1 correlation over about the last year. Now, why is that? Well, I don't usually like the question why, because in the hierarchy of questions for traders, why is the weakest question? Okay, it really is. You guys should always focus on what's happening and what you're going to do about it, or what you're supposed to do about it. The rest of it is hobby. Okay, if you're worried about why something's happening, that likely means that you're wrong and you want to understand why you're wrong, or you don't believe you're wrong and you want to figure out why the market is wrong. And both of those are bad. Having said that, I think the correlation between NASDAQ and Bitcoin is because the type of person who would buy only the NASDAQ is probably the type of person that would like crypto, tech for tech. So when they're selling off assets, they're likely going to be selling off all assets. They're not going to say, I'm dumping all my NASDAQ, but keeping my crypto because I'm an idiot. I don't know. The correlation is very high. So when I saw the sell-off coming in NASDAQ, I said, you know what? I'm going to dump every single piece of crypto that I own. And I did. Lastly, I want to say I believe in the technology and I'll be buying it again. But at the time that I sold it, I told the interviewer, I think it was Bloomberg, I'd rather buy it again at 60,000 in smaller amounts than hold it where I have it, because I just think the risk is too high for it to collapse. I don't think I call this a collapse yet, but
it sounds like we have another episode right here. We can get into that in another episode going forward. That's awesome.
The Bitcoin futures, by the way, I could have hedged it, but I decided to get out of it all instead. And probably if I buy it again, it'll be in the Bitcoin futures, probably the micro.
Awesome. That's fantastic. We're up against our deadline. Really appreciate you being here, Bobby. It's our time's up for today. We're going to do it again next week. I had a lot of fun and I learned a lot and really appreciate you being here.
Happy to be here. If you guys want to find me, you can email me at support@pathtradingpartners.com, or you can hit me at Twitter, which is Bob_Iaccino. I can't help you with the spelling. I don't even know how to spell it.
We actually did a tweet for you this morning with your handle on there. So you can go to NinjaTrader and just click on it and you'll find Bob right there. All right, everybody. Thanks for coming. Appreciate the thumbs up. Appreciate the interaction in the chat. And as usual, I do want to remind everybody, please be safe out there. Be good to each other. Thanks for coming.